The market doesn't just move, it hunts. Have you ever wondered if enter a trade and price takes you out and moves in your direction? That's not bad luck, that's liquidity. In this session, I'll teach you how liquidity really works. And we are going to speak about what liquidity is. What do I mean by liquidity? If you can see my chart, I'm just expecting what a sell setup on BTC USD. So what do I mean by liquidity? So liquidity is where stop losses and pending orders are placed. So when I say stop losses and pending orders, this is what I mean. This is what I mean. So a lot of people are placing their sells here, right? They're just placing their sells and their stop loss slightly above. So since that region is a liquidity, what will happen? Price will take them out, and price what? It will tap us in, then will smash what? Full take profit. So this is what I simply mean by liquidity. So liquidity is mostly a trap. A lot of people say it's a trap. So liquidity fuel the market. So I got to understand that price needs a fuel. Price doesn't just move up or down. Before price will make a move, there should be liquidity. If there is no liquidity, price won't move. So if there is no liquidity, price won't move to the downside. So the current move of the market, price has what? Price has swept liquidity. Price has swept liquidity. Price has swept liquidity. When price moved to the downside, price took out this liquidity before moving to the downside. So before price move, before any movement, there is liquidity in the market. So now let's talk about liquidity. Liquidity. So we understand what liquidity, they are above or below. They are above highs or below lows. So above this high, when price moved to this high, right? What did it do? There was liquidity above. So price took out the liquidity before moving to the downside. Right? That's the sell side liquidity. So let me identify it very well. Price took out that liquidity. Let's name it liquidity. Is most of the time represented with this dollar sign. Liquidity. So that's liquidity. Exactly. So this is liquidity above highs. So liquidities are found above highs. So when price took out that liquidity, when price took out the liquidity above, what did it do? It moved to the downside. So this is how liquidity works. Liquidity moves the market. So liquidity is the fuel of the market. If there is no liquidity, you see that price starts what? Consolidating, giving slow movement. Until price grabs the liquidity, it is going to keep on moving. So we have to understand the types of liquidity and examples of liquidity. So an example of liquidity is what? Equal highs and equal lows. What do I mean by equal highs and equal lows? Let me move equal highs and equal lows. So with this same scenario, when I say equal highs, what does it do? As she said, it simply means what? Double tops. So with this same scenario, as you can see, the price had what? A double top scenario. There was what? A double top scenario. Double top scenario. Let me play it. Okay, this is how it looked like. So equal lows, double tops. This one is equal highs, and these equal highs, the highs are equal, showing that what? This is what? A liquidity. There is liquidity above. So when price takes out this liquidity, it is going to move the same way this high. When price takes it out, it is going to move. So liquidity is all over the market. There is liquidity in the market. When there is no liquidity, price won't move. So liquidity is simply what? Is the fuel of the market. So now we understand we know the double top liquidity or the equal highs liquidity. Now let's go and look for an example of a clear example. Very good. So this is what? A double bottom. This is double bottom. So we call it equal lows. Equal lows. So this is equal lows liquidity. You see the equal lows? Yes, exactly. Double bottom. The bottom are double. So this is what liquidity. Liquidity lies below this range. So when price takes out, see that when price takes out this liquidity to move to the upside, exactly. So liquidity moves the market. If price doesn't take out a liquidity, it is not going to move. So there should be liquidity in the market before price move to the downside or move to the upside. So now let's talk about why price sweeps liquidity. If we spoke about it earlier, but we are going to point more about it. Why price sweeps liquidity. So smart money, when you say smart money, that's what institutional orders are. So smart money needs liquidity to enter big trades. So institutions, as I said, institutions cannot enter randomly. So institutions don't enter buy positions or sell positions anywhere. No, they need liquidity, they need orders, they need your stop losses. As you said, liquidity is what your where stop losses and orders are placed. So when these institutions find these stop losses, where these stop loss orders are placed, they just take it out to be able to move. So this is why what price sweeps liquidity. Price sweeps liquidity so that our price can move. So when price moves to liquidity, it takes the stop and then reverses, as I said earlier. So this is how price did. Price moved to liquidity, takes the stop. This is it. This was the higher high, right? Higher low. So price moved to liquidity, took it out from the uptrend, then went reverse to the downside. As easy as that. The same. Let's move to the next scenario. Price what move upside. Price took out the liquidity, took out those who had their buy positions, took out the buy position, took out their stops and reversed to the downside. As simple as that. So I hope you are understanding liquidity. So liquidity is what they move the market, and this is how liquidity works. It will just what move to liquidity, take out your stop, and then reverse. When I say move to liquidity, you understand what liquidity is. Liquidity can lie above, as you said, we have what liquidity can lie above. Price will take it out and reverse. The next type of liquidity is what the equal lows and the equal highs. When price comes to this double top scenario, take it out and move to the downside. As easy as that. And now let's talk about inducement. When you say inducement, a lot of people confuse between liquidity and inducement. Don't worry. Inducement is an example of liquidity. Liquidity is just what taking out your stocks, right? So the same way, the same thing inducement does. It's an example of liquidity. Another type of liquidity, we have structural liquidity. Let me add it and speak about structural liquidity. We also have engineer liquidity. They all form under liquidity. Structural. They are all fake outs. Liquidities are just fake outs, going to fake you out to take your stops and move the other way. So this is what liquidity does. So before you enter and be confident with any trade, make sure there is liquidity. There is liquidity. If there is no liquidity, probably you can hit TP and probably an 80% possibility that what you might hit SL. So these are all liquidities. We said inducement. So inducement is what is when markets trick traders into early entry. As I said, as I've marked my liquidity. So someone could enter early here, right? But it is an inducement I've marked. And I said the example of what liquidity, right? So this is an inducement. So if you enter early, price can take your stop while I'll be here waiting for price will take your stop and put me in this trade. So this is what liquidity simply means. So this is an example of what inducement liquidity. And now let's talk about structural liquidity. You see when price, the same scenario as here. Let's see how structural liquidity will look like. So when price takes out this liquidity and move to the downside, right? So this is how structural liquidity will be like. Price will be creating structure. You see the structure is higher highs and higher lows, right? Before it will tap us in and move to the downside. As easy as that. So the whole of this scenario, price break, all of these, price is creating what structures inside, internal structures, right? So this is what a structural liquidity. Price is what creating internal structure. So this is what structural liquidity. But this is what an inducement. Okay, then now let's talk about engineered liquidity. That's the last type of liquidity I want us to speak about. This is what the same scenario, the same sell scenario. If price takes liquidity, then reverse. What does engineered liquidity does? Price pull back, come to the downside, and then tap us in and move. So this is how engineered liquidity move like. So this is what engineer liquidity. This engineer liquidity. Then you've understood the three types of liquidity. What we understood that liquidity is what the where stop loss orders are placed, right? So price has to take liquidity. Liquidity is what fuels the market. Price has to take liquidity before changing direction, and price liquidity works in a way that what will price the price will move to liquidity, take out stock, stop losses, and reverse. We understood the types of liquidity. We have equal lows, equal highs, and liquidity lies what above, right? We understood that the major types of liquidity are what inducement, structural liquidity. These are examples: inducement, structural liquidity, and engineer liquidity. We understood inducement liquidity, which is the one I've marked here. So it traps traders to enter early. So if you enter early, inducement liquidity will be taken out, then I'll be triggered and I'll hit full take profit, right? So if you move to my Telegram community, a lot of my trades I use what inducement liquidity. A lot of my trade in the Telegram community I use inducement liquidity. So those who enter the position early, they are just what they are taking out. So those who enter these trades early, they are taking out. So the same here in this scenario as you can see in this scenario, what did price do? This was the liquidity. So those who entered early, so price took them out and triggered us in. This is what liquidity what does. This is what liquidity simply does. So we now understand inducement liquidity. That's what I really use most of the time. We now know structural liquidity. When price takes it out, creating internal structures, it's internal liquidity. So this tends towards a structural liquidity. And now we spoke about engineered liquidity. When price takes out, refuse to break structure to the upside or create structures, then just what move to the upside, tap and move to the downside, right? This is what engineered liquidity is. So we now understand the major types of liquidity. And I hope you enjoyed this session. We really dive deep into liquidity. So if you don't understand liquidity, I hope this session has really changed your perspective about liquidity, how liquidity moves the market, and how liquidity influences prices. Peace out. Hope by the end of this session you understood that the market doesn't just take your stop loss. No, it is engineered. So if you found this video educative, you change your perspective about the financial market, don't forget to like, comment, share, and subscribe to this channel so that you don't miss the next educative content about the financial market. Obedefek signing out. Peace.